weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets this week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, we'll focus on our key market indicators, as well as continue our discussion by reviewing the contributors and detractors of the market, all while looking at both equity and bond markets to provide a more comprehensive view of your market performance and the impact to your portfolios. Additionally, I want to highlight a webinar that John, Mark, and I will be hosting on June 30th. Now, if you enjoy these videos, we look forward to seeing you at that webinar because we'll do a further deep dive into market drivers for this year. Specifically, we'll take a look at all of these indicators and much, much more. So please make sure to join that webinar by clicking on the webinar's link on our website. So with that, let's hop right in. Now, on to the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 3.4% growth as of June 18th, which is slightly lower than our previous projection of 3.8%. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data fell by 3,000 claims, ending at 245,000, while continuing claims fell as well to 1.945 million. Now, as mentioned last week and previous weeks, we will watch this initial claims data very closely and track the trend as we move forward. This value, once it hits 250,000, has a significant association with the economy and the markets. So stay tuned and connected to our channel for updates. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement in both the 30-year and 15-year mortgage rates, ending at 6.81 and 5.96% respectively. Next, we usually jump into investor sentiment. This week, however, we don't have an update on the bull-to-bear spread, which remained at 3.1%. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship to the S&P 500. Remember, the VIX values above 30 are typically linked to large volatility, resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 20.62. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 10.3% probability of a 0.25% decrease and an 89.7% probability of no decrease in July. After the Fed met this week and announced no cut, the probabilities of a near-term cut are pretty low. I anticipate an uptick in the probability of a cut as we near September. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 0.12%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 0.44%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was negative 1.45%. Now, this was a relatively flat week, except with international stocks. And international stocks saw their first weekly decline in many months. However, the winner for this week goes to aggressive growth stocks. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, please do not hesitate to connect with one of our advisors today. Now, with that, let's jump right into our discussion around the contributors and the detractors that move these market indices in the past week. Now, what we saw last week with the S&P 500 dropping 0.12 points over the week, erasing many of the gains or some of the gains that we saw and marking the second consecutive week of modest losses. The NASDAQ dipped about 0.5% last week, reflecting losses in the tech-heavy growth names. The Dow Jones Industrial Average also was actually slightly higher by 0.1% as the cyclical and value plays continue to hold up a little bit better. Overall, the market ended the week mixed to down, weighing by geopolitical jitters and spikes in oil prices. Now, the snapshot of the bond market or the fixed income market, what we saw was the 10-year Treasury hovered around 4.37% and 4.39%, ending the week nearly unchanged. The 2-year Treasury closed at 3.9%, which was a slight dip from earlier in the week, which was 3.94% is where it started. And the 30-year Treasury remained stable and was essentially flat across the curve. Now, after understanding what happened in the markets, what are the key factors that drove these markets? Well, we'll discuss that in the next section, which is our contributors and detractors. So let's take a look at the contributors to the market performance. First, let's look at equities. Now, on the equity side, we saw some stock and some sector movers that really drove the market. Now, remember, it was pretty flat overall, so the impact of each one of these stocks was fairly limited. EQT Corp surged by 30% to new highs after strong Q1 results. We also saw Bank of New York Mellon and Crown Holdings also hit all-time highs following robust Q1 earnings. Kroger also gained by 9.8% on an upbeat earnings and raised guidance. CarMax also saw a 6.6% growth on strong used car sales. We also saw some major movement in the small cap space. Remember, these represent high volatility plays, and in our Dave Ramsey vernacular are considered aggressive growth. The key outperformers last week were SRMS or SRM Entertainment, which was up by 661%, NXTT, which is Next Tech Holding, which was up by 184%, SST Systems, which was up by 147%, and RGC, which is Regence Cell Bioscience, was up by 143%. Now, on the bonds and fixed income side, we saw some supply and demand equilibrium really come into play. Bond traders held steady, awaiting more economic data and fearing that rate cuts might not arrive swiftly enough to offset persistent inflation and growing federal deficits, thus putting this part of the market in a steady equilibrium. So let's now take a look at the detractors of the market. I felt like last week the markets responded appropriately to the macroeconomic data that came out during the week and the results of the FOMC meeting. However, when it came to the ongoing geopolitical risk, there was a lot of uncertainty that was in the air. The largest detractor in the past week was, well, geopolitical risk. With the U.S. involvement now in the Middle East, it remains to be seen how the markets will respond next. Specifically on the equity side, we saw geopolitical tensions and oil prices really take center stage. With the escalating Israel-Iran uncertainty, which triggered roughly a 7% jump in oil, which settled around $73 to $74 a barrel. This is a multi-month high that we're seeing. Rising energy prices also fed into inflation concerns, which in turn triggered caution ahead of the Fed's June meeting. As we've talked about previously, the Fed's decided to hold steady. So the Federal Reserve left rates unchanged at 4.25% to 4.5%, signaling a patient approach while raising inflation forecasts and cutting growth forecasts for 2025 to about 1.4%. Breadth and technicals were also a big part of this. Market breadth softened, with the NASDAQ and the S&P posting small weekly declines. The Dow fell about 1%, as we discussed previously. The technical piece of this, or the technical analysts, note that recent consolidation with the S&P 500 hovering near its 20-day moving average and showing slightly bearish momentum. On the fixed income side, we saw market stability amid tensions. So despite ongoing geopolitical tensions over the Israel-Iran situation and ongoing pressures from President Trump urging the Fed to lower rates, yields remained range-bound across the curve, refusing to budge lower. So what does this mean? Term premiums and fiscal risk. I think it's important to highlight that long-term yields, 10-year and 30 years, remain elevated due to inflation expectations and fiscal uncertainty, reflecting a lot of caution rather than exuberance. What was also interesting is that, as we mentioned, there's market silence. As I mentioned earlier, the bond market remains stable. This calm could be potentially deceptive. This calm could be a potentially deceptive lull, where markets seem complacent despite geopolitical and economic vulnerabilities. And finally, to recap, within the equity market, we saw a modest pullback in U.S. equities driven by geopolitical stress and inflation concerns. While cyclicals and financials showed resilience, tech-led growth areas lagged. Earnings from names like EQT, BNY, and Crown offered bright spots, but macro uncertainty kept the broader market in check. Bonds and fixed income. On that side of the world, we saw the bonds ended the last week largely stable, and as mentioned previously, pretty flat, with core yields staying at the 2-year being around 3.9%, the 10-year being around 4.38%, or ending at 4.38%, and as mentioned, the 30-year, which was flat across the curve. As mentioned, this calm reflects a market waiting for new data and Fed direction rather than reacting to headline pressure. Watch for economic prints or geopolitical news to break the status quo, especially if inflation remains sticky or if the deficit story intensifies. So what to watch in the week ahead? I think there's a few key pieces that we will definitely continue to watch and report out in the following weeks. But from the macro side or key data events, we see the June PCE or personal consumption inflation data that's going to be released. Consumer confidence data will also be released, as well as housing and GDP data will be released. Geopolitics, I think, must be highlighted, and understanding that any development in the Israel-Iran conflict may re-influence oil and risk sentiment. Certainly trade and tariffs. The U.S. Tariff pause expires on July 9th. Markets are certainly awaiting decisions or extensions that come from this. And, of course, the Fed's next move. Although the Fed affirmed potential cuts later this year, long-term bond traders remain skeptical, wary of inflation and fiscal drag. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.